Welcome to the Holistic Helpline, your shortcut to staying well informed.
Glad to be here.
Today, we're doing a deep dive into something a lot of people are asking about: cryptocurrency taxes.
Yeah, it's a big one and often confusing.
Exactly. You've told us you want to get a handle on this quickly and thoroughly, so that's our mission today.
We're going to break down how the IRS looks at these digital assets and what you really, truly need to know for tax season.
We want to cut through that complexity. And remember, you can always find more info on our website, www.myholistichelp.com.
Okay, let's get into it.
So where do we even start? What's the absolute baseline understanding we need?
Well, I think the most fundamental point right off the bat is how the IRS sees crypto. They don't view it as currency like dollars or euros.
Okay, not currency. So what is it then?
They treat it as property, like stocks or bonds or even, real estate in a way.
Property. Huh. That sounds like a small difference, but I guess it matters.
Oh, it matters a lot because it means all the general tax principles that apply to property transactions, they apply to crypto.
Right, so selling property usually triggers taxes.
Yeah.
Give me an example with crypto where that property classification makes a real difference.
Sure. Think about just using Bitcoin to buy a coffee or maybe pay for something online.
Yeah, people do that.
Right. But because it's property, the IRS sees that transaction as you selling the crypto first for its value at that moment.
Selling it, just to buy something.
Effectively, yes, for tax purposes.
Right.
So if the crypto went up in value since you got it, you've got a taxable capital gain right there.
Wow. Okay, so even small everyday purchases could technically be taxable events.
Technically, yes.
Yeah,
There's the gain. You could also have a loss, of course, if the value went down. But it means even little transactions create a potential reporting need that catches a lot of people by surprise.
Okay, that's a huge point. So this brings us to capital gains and losses. You mentioned them. Can you break down what they are and, crucially, the tax rates involved?
Absolutely. So a capital gain is basically the profit you make when you sell or exchange your crypto for more than its basis, usually what you paid for it.
Got it. Profit equals gain.
And the tax rate on that gain really depends on how long you held the crypto. This is key.
Right.
If you held it for 1 year or less, that's a short-term capital gain. And that's taxed at your ordinary income tax rate.
The same rate as my salary, for example.
Pretty much, yeah. Whatever your tax bracket is for regular income. But if you hold the crypto for more than a year before selling...
That's long-term, right?
Exactly. That's a long-term capital gain.
Right.
And the federal tax rates are much lower currently, 0%, 15%, or 20%, depending on your overall taxable income.
0%. For some people.
Yes. For lower income individuals, the rate can actually be 0, then 15% for most people, and 20% for higher earners.
That's a big difference compared to ordinary income rates.
Huge difference. Plus, keep in mind, there can also be the net investment income tax for higher earners, and state taxes often apply too, so the total can be higher. But the federal incentive to hold for over a year is clear.
Definitely seems like holding long-term is tax advantaged. Okay, what about other ways people get crypto? Like mining.
Mining. Yes, that's taxable too. When you successfully mine crypto, the fair market value of the coins you receive at the time you receive them is taxable income.
Income in the year you mine it.
Correct. Now, there's a bit of nuance. Is it a hobby or are you running a mining business?
Does that change things?
It does. If it's considered a business, that income is also subject to self-employment taxes, Social Security, and Medicare. If it's just a hobby, it's still income, but generally not subject to the SE tax.
Okay. And then if you sell that mined crypto later?
Then the capital gains rules kick in again, based on the difference between its value when you mined it, your basis, and when you sell it.
Got it. What about getting crypto, say, as a gift, or maybe inheriting it?
Good question. Receiving a gift of crypto isn't immediately taxable to you, the recipient.
Okay, that's good.
But when you eventually sell or trade that gifted crypto, you will have potential capital gains or losses. And usually your basis is the same as the person who gave it to you.
So you inherit their cost basis.
Generally, yes. Inheritance is a bit different, though. If you inherit crypto, your basis is typically stepped up to the fair market value on the date the person passed away.
Stepped up, meaning?
Meaning, if the crypto was worth, say, $50,000 when the person died, that $50,000 becomes your starting point, your basis. Any gain or loss is calculated from that value going forward when you sell.
Interesting. That could be a significant benefit. Okay, the crypto world also has things like forks, airdrops, weird names, but real events. taxable.
They certainly can be. An airdrop, where you basically get free tokens just for holding another cryptocurrency, especially after a hard fork. The IRS view is generally that if you receive those new tokens and have control over them,
Meaning you can sell them or transfer them?
exactly, if you have dominion and control, then the fair market value of those new tokens at the time you receive them and they're recorded on the blockchain is considered taxable income.
More income to report.
Yes. And that value then becomes your basis for those new tokens going forward.
Okay. What if you actually get paid in crypto, like wages from an employer?
If you receive wages paid in Bitcoin or another cryptocurrency, that's definitely taxable income. It's treated just like receiving wages in dollars.
So my employer reports it.
They should, yes. The amount of income is the fair market value of the crypto in US dollars on the day you receive it. And your employer is responsible for the usual payroll tax, withholdings, income tax, FICA, FUTA, and reporting it on your W-2 form.
Makes sense.
Yep.
Now, we talked about using crypto to buy things being a taxable sale. What about just the initial purchase of crypto with, say, US dollars? Is that taxable?
No, simply buying crypto with fiat currency like US dollars isn't a taxable event in itself. Think of it like buying stock. You don't pay tax just for buying the shares. The tax event happens later, when you sell the stock, or in crypto's case, when you sell it, trade it for another crypto, or use it to buy goods or services.
Right. That's when you realize the gain or loss.
Precisely, based on the change in value from when you bought it.
Okay, one more scenario. Donating crypto to charity. A lot of people are interested in that. Tax implications.
Donating crypto to a qualified charity can be quite tax efficient. Generally, you don't recognize any income, gain, or loss when you make the donation itself.
So no tax triggered by the donation.
Correct. And you might get a tax deduction. If you've held the crypto for more than a year long-term again, you can usually deduct the full fair market value at the time of the donation.
Wow, that's potentially a double benefit. No tax on the gain and a deduction for the full value.
Exactly. If you've held it for a year or less short-term, the deduction is typically limited to the lesser of your basis or the fair market value. So again, holding long-term is often better for donations too.
Good to know. Some crypto tax software can even help track those donations, right?
Yes, some platforms allow you to tag donation transactions, which makes reporting easier come tax time.
This all comes back to something you mentioned earlier, records. It sounds absolutely critical. What kind of information do we need to be tracking?
Meticulous records are non-negotiable, really. For every single transaction, buying, selling, trading, spending, receiving, mining, donating, you need records.
Like what specifically?
You need the date of the transaction, what type of transaction it was, the specific crypto involved, the amount of crypto, and crucially, its fair market value in US dollars at the time of the transaction.
Okay, dates, amounts, values.
And for purchases, you need your basis, what you paid for it in dollars, or maybe the value of other crypto you traded for it. Having all this organized will save you a massive headache later.
I believe it. So when tax filing season rolls around, what are the key IRS forms people dealing with crypto should know about?
The main one for reporting sales and exchanges is Form 8949, Sales and Other Dispositions of Capital Assets.
8949. Got it.
That's where you list out the details of each sale, or trade the dates, proceeds, basis, and calculate the gain or loss.
Okay.
The totals from Form 8949 then flow onto Schedule D of your main Form 1040. Schedule D summarizes your overall capital gains and losses for the year.
And if you had crypto income, like from mining or getting paid?
That might go on Schedule 1 for additional income. And if your mining, for example, qualifies as a business, you'd likely also use Schedule C to report that income and related expenses.
It definitely sounds like it can get complicated, especially with lots of trades or, DeFi stuff. Is using specialized crypto tax software a good idea?
For many people, absolutely, especially if you have transactions across multiple exchanges or wallets or a high volume of activity, it can be really hard to track manually.
How does it help?
These software platforms can often connect to your exchange accounts via API, import all your transaction data, attempt to match up buys and sells, calculate gains and losses using different accounting methods, and even help generate Form 8949.
That sounds like a huge time saver.
It really can be. And as we mentioned, some help with specific things like donation tracking. But they aren't perfect. You still need to review the data.
Right. When should someone maybe skip the software or supplement it and go straight to a human tax professional?
I'd say if you're feeling really overwhelmed, if the software results seem confusing or incorrect, or if you're involved in more complex areas like DeFi lending, liquidity pools, NFTs with royalties, futures trading, or if you had very large gains or losses.
So complex situations or high stakes.
Exactly. A tax pro who genuinely understands crypto, and not all do, so you need to check, can provide personalized guidance, ensure accuracy, and potentially find strategies the software might miss. It's often worth the investment.
That makes sense. Now, there's been talk about more reporting coming from the exchanges to the IRS. What's the deal with that?
That's right. There are new regulations kicking in, starting with the 2025 tax year, which you'll file in 2026. Brokers and exchanges will be required to report certain digital asset transactions to the IRS and to you on a new form, Form 1099-DA.
1099-DA. Okay, so similar to how stockbrokers issue 1099-Ds now.
Essentially, yes. The goal is to increase tax compliance by giving the IRS more direct information about crypto sales and exchanges conducted through these platforms.
Does that mean if I don't get a 1099-DA, I don't have to report?
Absolutely not. That's a critical point. You are responsible for reporting all your taxable crypto transactions, whether you receive a form or not. The 1099-DA will only cover certain transactions on certain platforms.
So it doesn't cover everything, like maybe peer-to-peer transactions or DeFi?
Likely not, no. So the burden remains on you, the taxpayer, to keep those thorough records and report everything accurately. Underreporting is tax evasion, plain and simple.
Good warning. Let's circle back to definitions for a second. How does the IRS actually define virtual currency? Is it just Bitcoin?
No, it's broader than that. The official definition is a digital representation of value that functions as a medium of exchange, a unit of account, or a store of value.
Okay, pretty general.
Yes, but they emphasize convertible virtual currency, meaning it has an equivalent value in real currency, like dollars, or acts as a substitute for real currency. Bitcoin, Ethereum, most well-known cryptos fall under this.
And they specifically say it's not treated like foreign currency.
Right. That's an important distinction. The tax rules for foreign currency gains and losses don't apply to virtual currency. It's treated as property.
Oh,
it's back to property.
Always back to property. Okay, we touched on self-employment and wages earlier. Can we just clarify the employment tax side specifically?
Sure. So for independent contractors receiving crypto payments, the fair market value at the time of receipt is self-employment income. You owe income tax and self-employment tax, Social Security, and Medicare on that amount.
Okay, contractors pay a C-tax. What about regular employees paid in crypto?
For employees, crypto wages are subject to federal income tax withholding, FICA taxes, Social Security and Medicare, both employee and employer shares, and FTUA tax, federal unemployment.
And the employer handles the withholding and reporting.
Yes. The employer calculates the value at the time of payment, withholds the necessary taxes, and reports it all on the employee's Form W-2, just like cash wages.
Got it. What about businesses making payments using crypto? Say, paying a vendor or contractor in Bitcoin. Reporting rules for them.
Yes, information reporting rules apply, just like payments made with other forms of property. If a business pays, say, an independent contractor $600 or more in crypto for services during the year.
The classic $600 threshold.
Right. They generally need to issue a Form 1099 NEC to that contractor and file it with the IRS, reporting the fair market value of the crypto paid. Same idea for other types of payments like rent or royalties if they hit the $600 threshold and are paid in crypto, likely a Form 1099 MISC in those cases.
So businesses paying out crypto need to track the value and issue 1099s. What about businesses accepting crypto from customers?
There can be reporting there too, mainly involving third-party settlement organizations or TPSOs, some payment processors. If a TPSO processes crypto payments for merchants, those payments count towards the Form 1099K reporting thresholds. Currently, the threshold is generally over $20,000 and more than 200 transactions per merchant per year, though there's always talk of lowering that.
And they value the crypto at the time of the payment.
Yes. The fair market value on the payment date is used when determining if the thresholds are met and for the amount reported on the 1099K.
Okay, last deep dive area. Form 8949. You said it's key. Can you give us a bit more detail on what goes into that form?
Sure. Form 8949 is really the backbone for reporting your crypto capital gains and losses. Its full title is Sales and Other Dispositions of Capital Assets.
And crypto counts as a capital asset.
Exactly. The instructions explicitly mention virtual currency, cryptocurrency, even NFTs now. They're all treated as property subject to capital gain loss rules.
So what information do you put on it for each transaction?
For each sale or disposition, you list the description of the property, like Bitcoin or Ethereum, The date you acquired it, the date you sold or disposed of it, the proceeds, what you received in dollars, and your cost basis, what you paid in dollars.
Proceeds minus basis gives you the gain or loss.
Correct. The form has separate sections for short-term, held 1 year or less, and long-term, held more than 1 year, transactions. You calculate the gain or loss for each line.
What if the basis reported by an exchange on a 1099-B or the upcoming 1099-DA is wrong?
Good point. Form 8949 has specific columns and codes, like in column F, to make adjustments or explain discrepancies, like if the basis is incorrect or missing. The instructions detail how to use those codes.
So you can correct errors. Do you have to list every single tiny transaction separately? What if someone has hundreds?
Generally, yes, each transaction should be listed. However, the instructions do provide some exceptions where you might be able to summarize transactions, particularly if they are reported correctly on a Form 1099-B and presumably future 1099-DAs, and no adjustments are needed. But you need to check the specific rules carefully. Often, using crypto tax software is the practical way to handle high volume.
Okay, that clarifies Form 8949 quite a bit. It really seems central to crypto tax reporting.
It absolutely is for anyone selling, trading, or spending their crypto.
So wrapping this up, if you had to pick one crucial takeaway from all this for our listeners, what would it be?
It really boils down to understanding that the IRS treats cryptocurrency as property. That single classification drives almost all the tax consequences we've discussed.
Property, not currency.
Exactly. And flowing from that is the absolute necessity of diligent, detailed record keeping for all your crypto activities. Dates, amounts, values, basis, everything.
Don't wait until tax time to try and piece it together.
Please don't. It becomes exponentially harder. Use tools like spreadsheets or crypto tax software throughout the year. And don't hesitate to get professional help if you're unsure or dealing with complex stuff.
Sound advice. Staying informed is key, as this area is still evolving.
It really is. Regulations are changing, interpretations are clarified. Staying current is vital for compliance.
Absolutely. Well, this has been incredibly helpful. Thank you. It definitely provides a solid foundation. So a final thought for everyone listening. As this crypto world keeps changing, what proactive steps can you take, starting today, to make sure you're truly prepared for your future tax filings involving crypto? Something to definitely mull over.
Good question to ponder.
Thanks again for joining us for this deep dive on the Holistic Helpline. For more information and resources, remember to visit our website at www.myholistichelp.com.